Hi, Dominique. Excited to have our kind of week ahead session this weekend. So again, this is April 9th. We're both in kind of unique locations. I'm in the US, actually in South Florida. And you're, obviously you're in California, and you can talk about what you were doing earlier a bit as well. So again, this was, especially concerning the Fed, was again quite interesting week. And as we've seen the past few weeks, continuation of higher yields, and maybe potentially a slowing of the flattening or inversion of part of the curve. So maybe kick off kind of what your big takeaways were from this past week, and certainly from some of the key comments and obviously the Fed minutes.
So, yeah, this was actually all the Fed action was this week. We have a list of speakers this coming week, but everything happened over the past few days. And Brainard kicked off. So I think Brainard had been in a self-imposed silence because her confirmation was in the balance. So let me explain a little bit where we stand on this confirmation. It has to go to a full Senate floor, but it's only a formality. I think Brainard, Powell, Jefferson will get through with bipartisan support, and Professor Cook will get through just on Democrats' vote, but she's cleared Senator Manchin, so she's fine. It's all in the bag, so to speak. So we had the first sort of important speech from Brainard in her new capacity as a vice chair. And really, it was a big speech. She basically prepared us for the minutes message on QT, which was quite aggressive. But, so she warned us QT was coming in May. It was going to happen faster. So that was a really new part of the speech. And it was quite market moving. The part on rate hikes, I think, was not that big a deal because it was all, Powell had made those points, that they were going to be aggressive. It made those points before. I think the market overestimated the sort of new aspects of her comments on hikes, in part because she started the speech by citing Volcker, which, to me, whenever someone, political figure like vice chair of the Fed, quotes Volcker, it makes me think they want to sound hawkish, but they are probably not going to be that hawkish. And that's why I disagree with the market, because she said that they were prepared to do 50s if needed, but on the other, which is nothing new. But on the other hand, she also said she expects disinflation from better supply chains, from a recovery in participation, and she thinks that by the end of the year we will see this miraculous non-monetary disinflation. And to me, that it was nothing new. And the fact that she still thinks this, even after the new supply shocks from the Ukraine crisis and the new supply shock from the COVID in China, and China sticking to its zero COVID policy, she still thinks we are going to see disinflation after that, above and beyond what's coming from monetary policy. To me, is not hawkish at all.
Yeah. So I think a lot of it just came from the fact, I obviously do not have the depth of knowledge on the subject that you do, but she's considered historically to be one of the dovish people on the Fed, and obviously now she's stepping into this pretty important role as kind of number two. And I think it just kind of shocked the market a little bit that she came out talking pretty freely about 50 basis points hikes and QT starting very quickly. I think you're right that by going through the other stuff she said and about inflation still, many factors can drag it back down by the end of the year. People kind of saw through that or ignored that. That was my impression. That
Yeah, no, I agree. And I think the market, so as you know, I've changed my view on the terminal rate. I think it's going to be close to 8%. We can talk about that. But I think it's going to be much higher than what market is pricing and certainly last longer. I can't see the Fed cutting in 2024. So I think the market is just not prepared for the persistence of high inflation, which I think is very likely after the shocks we're seeing. But before we got there, maybe we should talk a bit about QT because the QT announcement. So the sort of final number, 100 billion a month, was what I had expected. So I had published a note on QT in January or early February. I expected mid-year start and around 100 billion.
I remember, Yep.
But I thought it would be phased in much more slowly. I thought it would be phased in, over 6 months, maybe even a year. So it was definitely more aggressive than what I was expecting. And I think it could be a way for the doves on the committee, so Brainard, to, if you will, throw a bone or make concessions to the hawks. Because who are the hawks? The hawks are, led by George. I mean, she can be relied on to be consistently, at the top of the dot plot. And she's been arguing for a long time, even starting last year, actually, that the Fed should do QT before doing hikes because she thinks that the curve would flatten much less if the Fed had shrunk the balance sheet ahead of the hikes. And she doesn't like a flat curve. She thinks it supports excessive risk-seeking. She thinks it's bad for bank margins. So she's been campaigning for doing QC much earlier. And then on the part of the dove, so the academics, if you will, because, Cook is a dove, she's a professor, Brainard was a Harvard professor. They think that the rates are much more important for the stance of monetary policy than the size of the balance sheet. So it could well be that they were prepared to give this to the hawks on the committee, so to give this aggressive QT to the hawks on the committee, thinking that actually it wouldn't impact the monetary policy stance much. So, that's my reading. Maybe I'm too much of a conspiracy theorist, but the bottom line is I don't see the FOMC realizing that their model of, expectations augmented Phillips curves, the things that Yellen described in the 2015 speech, where she said, we don't need to worry about supply shocks as long as inflation expectations are well anchored, which is basically what was guiding Powell's policy making until very recently. I think psychologically they are still wedded to this model. They haven't let go of it, and that's why I expect them to be relatively dovish. Until I don't know. We can start talking about the CPI this week, which I think is going to give everybody a bit of a sticker shock.
I just had 2 questions before we move on. So just one is on the breakdown between treasuries and mortgages, and I think you were saying, I guess, is that about the breakdown that you thought? And wouldn't, and I could be wrong, but wouldn't they're more concerned about, say, mortgage rates? Like, if anything, they wanted to say they may view housing as somewhat of overheated. So wouldn't they prefer if you're going to have longer end rates higher, yields and higher mortgages or treasuries, I'm assuming they would rather have it in mortgages. Is that correct? And is that representative of the breakdown that they're talking about?
So I think you are spot on there, Andrew, because actually they've been saying for years that we would rather err on the side of being too dovish than too hawkish, because if we need to tighten, we can do it very easily, which I think was complete overconfidence. And so you no, but you're absolutely spot on, because when you look at aggregate demand, there are really only two components that are interest sensitive. Consumer durable, cars, especially, well, to simplify, let's say cars, and then residential real estate, so mortgages. And for sure, mortgages are reaching 5%, the 30-year fixed. It's gone up a lot, but guess what? Inflation is a couple of percentage points above that. So even mortgages at 5%, which is certainly not something, including myself and people including myself, would have expected just 3 months ago. It's not that tight. You're still paying a negative real mortgage rate to buy your house. And look at
if you expect your house to go up 9 or 10% a year, then that's a pretty good trade. Yeah,
and especially now, it's actually going up by 20.
conservative. Yeah,
close. I mean, it's not going to stay there. In fact, I think it's going to slow down. I mean, not right away. But the thing is, so they need to see these mortgage rates go up quite a bit, and typically the spread of, for instance, the 30-year fixed to the 10-year has been quite stable, except during periods of crisis. But because of repayment, the actual life of a 30-year mortgage has been closer to 10 years than to 30. So it tracks the 10 years quite well. But that said, the problem they have is that because rates are going to go up, there won't be as many refinancing. And so they are going to be below the redemptions of MBS are likely to be below the caps, the 35 billion caps monthly that they have. And so they said, this is a problem. So we are going to go for outright sales of MBS. They didn't tell us when. They said, when QT will be well underway. The typical central banker language where you remain vague so that you have a lot of room for maneuver and
optionality.
Yeah. So
when would you expect them to start selling? Do they have to announce that change?
So yes, because the way it's going to happen is that, so we've been prepared. In May, they are going to give us final parameters, and they are probably going to stick with the caps, see how far for a few months, at least. I think they expect to phase the caps for in 3 months, over 3 months. So they are probably going to stay with the caps and not do outright sales until we are past these 3 months and see how much redemptions there are, whether they've been able to shrink fast enough their portfolio of NBS, and then they'll tell us what they'll do. But I have to say, I am very, very doubtful that they will be able to shrink the balance sheet or the portfolio of the security by 1.1 trillion a year. Last time they tried to shrink it, it definitely didn't go as planned. And the thing that I think we've all lost track of is that before the crisis, there were only 2 central banks in the world that had an operating framework similar to what the Fed has. And these were the RBNZ and the Norges Bank for very specific reasons. So there is no experience of a central bank of the size and of the experience of the importance of the Fed going through this process. And the thing about reserve, it's a fantastic deal for the banks because they get a safe asset with market rate of returns. They don't have to bear, all the annoying things about loans, finding the borrowers, evaluating them. And I mean, come on, the reserves are the best deal in town. So I have a nagging suspicion that the more you supply reserves to the banks, the more they want them. And so this idea that you can shrink the balance sheet by 1.1 trillion and nothing happens to your money market, I have my doubts.
Yeah. I mean, the truth is, maybe for other reasons, a lot of the banks' equity performance has been pretty weak, despite interest rates going higher. And, in what maybe it's the flattening of the curve a little bit, but generally you would assume banks would do well in this environment. So those are great points. Okay, let's move on to what you think for the kind of week ahead.
So, I mean, no question, the week ahead, the star of the week is the CPI. So the consensus is quite, optimistic. They think there will be a gap of 70 basis points between core and headline month on month, which makes sense to me because we've just had in March, I think one of the highest, if not the highest, increase in gas prices in the history of, since the oil shocks. So that for sure, we're going to have a big jump in headline. Now, the core, the consensus on core is only 50 basis points. Because of the Mannheim, the auction for used car, the prices have been going down. And the thing is that I think was valid probably a few months ago, but now price increases, unfortunately, have become so generalized that even with used car prices falling month on month, we could still have a higher core than 50 basis points. And if we don't this month, with what's going on in Ukraine, with supply chains in China, China cannot let go of its zero COVID policy. It's going to be the demise of Xi Jinping, but it's also the demise of global supply chains. So we're going to see inflation move higher.
Yeah. Okay, cool. And then obviously that's a big one. Anything else that for the week coming up?
So we will have retail sales.
That's usually a huge one. Yeah,
that's a big one. And I agree with consensus. We'll have an increase that is lower than inflation. So we're still in this scenario of a sliding real consumption because real incomes are being eroded by high inflation. No more government money coming the way of household, even with, or if there is, it's more at the state level, because in terms of Washington giving handouts to a household, not possible. The Republicans won't go for it. They are banking on a big victory in the midterm. And then you have Senator Manchin and Senator Sinema, they won't support it. So we have household income being eroded by inflation, no more government handouts, and then we have stable, in fact, the last data point we had, so an increase in household savings. It means real income depend only on wages and employment. Real wages are falling and employment is slowing. So all in all, this sort of a very gradual glide into what I expect is going to be a recession next year.
Well, if we saw something like a negative number for retail sales, would that spook the market? And I guess which way? We say equities. I guess rates is pretty clear that yields probably would go down. How would you think equities would respond to that?
Well, I think equities should go down, but frankly, in terms of yields, I'm not sure, because we are in a situation where the Fed has no choice but to hike, and that's happened before. In 79.
I guess the curve would flatten, more likely, instead of just all yields coming down. Yeah.
Definitely.
Okay. Anything else? I guess it looks like a pretty busy week. I mean, there's Michigan consumer confidence is also, I have just reading your report, PPI, business inventories, New York Fed Empire Survey. So there's a lot of stuff
There's a lot of stuff. I mean, the two key ones are what you mentioned, sure, confidence, consumer confidence. I mean, the big news on confidence was if it went up, but actually it's very unlikely. Let me make a plug here for, our new sentiment indicator, which is based on the beige book and correlates very well with the PMI. And with consumer confidence. And you may be aware of a paper by Blanche Flower, who used to be on the Bank of England MPC on using consumer confidence as a leading indicator for recession. And based on this paper, we should be in recession soon. And what I found absolutely fascinating is that Dalvir, Macro Hive's Dalvir has, cooked up a super interesting index based on natural language processing of the beige book, which is actually historically has been a really good indicator of recessions. And so as I was saying, this index correlates really well with the PMI and with consumer confidence, and it also points at a recession. So that's so consumer confidence. The big story there would be if it increased, which the consensus doesn't think, and I don't think either. And then you have the small business survey. The SBOI survey, which also, PMI, consumer confidence, small business surveys, they are very correlated. They are all pointing down. And that's what consensus expects, and that's what I expect too.
Okay, awesome. Anything else for the upcoming week, or?
No, these are the key points.
Okay, awesome. Okay, cool. All right, it was great chatting. Enjoy the rest of the weekend. Good luck, everyone kind of watching, listening to the video. And as always, please feel free to reach out to us. Any questions, any thoughts, any things we can improve on, that would be all wonderful to hear.